Winston and Felix here, and as the Fed holds rates steady amid growing recession fears from Trump's policies, NVIDIA's GTC event is unveiling a rare bright spot in the market, searching for where do we go from here? And here is what you need to know about today's pivotal developments. For those of you with TikTok brains who just need the essentials quickly because you can't make it through a full video, here is what my investment banking experience tells me matters most. The Fed's decision today signals a continued cautious approach. Besson's recession warnings have rattled investors, and despite NVIDIA's groundbreaking announcements, shares have actually dropped. Look, I've spent over a decade investing, analyzing these exact market conditions, and I can tell you what we're seeing today creates both significant risk but also extraordinary opportunities depending on how you position yourself. And you'll notice I'm not wasting your time with basic concepts here. Instead, I'm going to give you the professional analysis that would have cost you thousands of dollars in consulting fees. Now, Winston, of course, has actually helped me organize all of these notes this morning. Well, he mostly slept and drooled on the research, but I'll take what I can get, right? So let's dissect the market moving events here today, shall we? So I'll walk you through exactly what the Fed's decision means for your portfolio, how to interpret Besson's recession warnings, and whether NVIDIA's drop is actually a buying opportunity or a warning sign. Have you got a pen ready? Take notes so you get the most out of the next few minutes here. Right, so the markets were seeing red yesterday, and frankly, it's not terribly surprising given what's happening. The Federal Reserve has just announced they're holding steady, which is precisely what most of us in the banking world expected. I've spent years analyzing these kind of decisions, and this one follows the typical Powell playbook. Cautious, measured, and rather predictable. Dull, some might say. Now, the interesting bit isn't so much what they did today, but what they are signaling for the future. You see, the market is already betting, quite heavily, I might add, on rate cuts later this year. The CME FedWatch tool, which is something you should absolutely familiarize yourself with, and I'm going to put it on the screen here for you, is showing about a 55% probability of our first rate cut by June 18th. Write that date down, June 18th, first rate cut. Because that's when we could see that first meaningful shift in money becoming cheaper and therefore your growth stocks going, the way you want them to go. Now, before we dive into the specific market impacts of today's events, I want to be straightforward with you. If you want to learn how to spot the stock breakouts before they actually happen and learn to sell before a stock collapse, might be a little late for this time around, but there'll be another collapse within 12 months. I promise you that because it happens every year. I've got something really exciting to share with you. I've literally recorded the rules that I learned from my mentors, who'd learned from their mentors and their mentors, all guys who worked on Wall Street or in the Chicago options exchanges. And I've put that together into a 15-minute masterclass. Like everything I learned as a banker and as a trader, the same strategies that helped me achieve financial freedom. And why do I want to give it to you? Because I think it's insanely unfair that we are not given financial education. 0.001% get financial education because they happen to land the right job inside of a bank. And I was very lucky to get that job. I was literally at the right place at the right time. I was at a party. I met a banker who was a friend of somebody. That's how I got that job. It had nothing to do with qualifications whatsoever. And then I learned what I now know, and it's helping me to, do whatever the heck I want. So our mission here is to make 1 million people financially free. And now that we have reached 250,000 subscribers for this beautiful community here, I'm very hopeful that we're actually going to do that in the next year or so. So come and join us, watch the masterclass, and get free in life. And the masterclass can be found at felixfriends.org/get free, because that's what I want for you. And your freedom might look like, whatever it looks like for you. It might be hiking, sitting on a beach, spending time with your family or your dogs or your, whatever it is you want to be doing with your time. But it probably isn't getting up at 7 a.m, getting into a car in the cold, getting a coffee, driving to work for an hour, sitting in a cubicle, getting yelled at occasionally by somebody you despise, and doing something that, if we're honest with ourselves, probably isn't all that meaningful, right? Well, that may or may not be you, but that's a lot of people, right? So come and get free with us. Check it out. Links down below. Now back to rate cuts. So why are rate cuts expected at all? Well, there are four critical factors at play here. First, we're seeing economists revise growth forecasts downwards. And I was just reviewing these numbers with Winston here this morning. Winston, come on. He's very good at sniffing out those kind of numbers, very large nose. And well, he was quite concerned. He was concerned about the impact of tariffs and government spending. That's what he said to me while he was chewing the cables. And second, we've got inflation, which appears to be moderating towards that magical 2% target. That's what this nose told me here. And if that trend continues, well, the Fed finally has room to maneuver without worrying about reigniting those inflationary pressures we've all been suffering through. And the third factor is global economic risks. And my word, there are plenty of those. Trade tensions, geopolitical uncertainties, they're creating headwinds all over the place, right? There are Houthis being shot at and Ukrainians and, Gaza, and there's so much going on in the world, isn't there, Winston, which is why he's so worried. And all of that could force the Fed's hand towards a more accommodative stance. And then finally, and this one's crucial, market expectations are already pricing in these cuts. So the Fed knows this, and they're typically rather reluctant to surprise the markets. In my experience, they prefer stability over shock value, which is maybe what you would do if you were a banker too. Now, pivoting to the corporate world, there's been quite a bit of turbulence lately. The orange president, Trump, continues to make his presence felt in market discussions. And while he hasn't made any real headline-grabbing economic statements in the last 2.5 hours, his ongoing critiques of current policies continue to create, well, I'd call it an atmosphere of sort of heightened uncertainty. And any trader and any investor worth their salt knows that the markets hate uncertainty more than almost anything else. And perhaps more significant for immediate market sentiment is what Treasury Secretary Scott Besson, the Almighty, said recently, and this is quite sobering. Winston had to lie down on that one. Besson essentially warned that there is absolutely no guarantee America will avoid a recession. Now, I spent a small fortune on my economics education at university, and I can tell you, when a Treasury Secretary starts using that kind of language, you best pay attention. Besson specifically cautioned that recent market corrections might not fully preclude a downturn. He's advocating for continued fiscal discipline, that means spending less, rather than short-term stimulus, which is what we've been used to since, Clinton, right? And this kind of talk has especially rattled investors and those with a more conservative risk profile particularly. Now, would you agree that that's a sensible thing to do given the circumstances? Well, yes, I think so. You can't be spending money you don't have forever after. At some point, the Grim Reaper is going to come knocking because you're going to go bankrupt as a country, right? Now, there is one bright spot though, amid all its gloom, and that is what Jensen Huang revealed at NVIDIA's GTC 2025 keynote, the man who will single-handedly push the market up, possibly. So Huang unveiled the Blackwell Ultra GPUs, along with something called the Rubin AI platform. And I thought that was a sandwich, but I was disappointed. And what they're doing here aren't just incremental little improvements. It's not an iPhone in a slightly different shade of blue or with a camera that's ever so slightly better at taking selfies. These GPUs are supposedly 40 times more powerful than their predecessor. Absolutely staggering technological leaps. And these products are aimed squarely at the data center market, which is projected to be worth about $1 trillion globally. Now, despite this impressive tech showcase, NVIDIA's share price actually dipped, proof that even the most innovative companies aren't immune to the broader market concerns here. And what Huang has done here is set a new benchmark for the whole industry. His keynote wasn't just a product launch, it was essentially throwing the gauntlet to competitors. Take a moment and consider how that might affect the competitive landscape going forward. Right, so what we're witnessing here is a fascinating interplay between monetary policy from the Fed and corporate developments. The Fed's hesitation to implement an immediate cut is clearly weighing on, well, sentiment, right? There's this undercurrent of expectation that a rate cut later this year might provide a lifeline to struggling sectors, technology in particular. And when I was working in banking, we'd spend tens of thousands of dollars annually on sentiment analysis tools. And I'm seeing the same pattern emerging now. The question you should be asking yourself is, how might these future rate cuts affect your specific portfolio holdings? Have you considered which of your investments will benefit the most when Powell finally pulls the trigger? Now, regarding political and fiscal narratives, Besson's recession warnings have truly sharpened markets' focus. I've been analyzing fiscal policy for over a decade, and when the Treasury Secretary starts talking openly about recession risks, well, it's rather like the captain of a ship mentioning icebergs, you know. You might want to go and find yourself, at least find the location of those life jackets. And this concern becomes even more acute when you factor in the public disputes involving figures like Musk and the politically charged commentary from the President Trump. So what we're seeing here is this perfect storm where macroeconomic challenges, corporate governance issues, and political uncertainty are all coming together. It's quite reminiscent of conditions I observed in 2018, though with different catalysts. Now, despite all this dreary news, there is a substantial bright spot: technological innovation. Winston actually barked at the screen during Huang's keynote. He's a fan. The Blackwell Ultra GPUs and the Rubin AI platform, the sandwich platform as I'll call it, represents a very compelling counter-narrative to the economic doom and gloom. The best data, the best analytical tools that you'd have if you're working in a big bank or a hedge fund available to you for price of a couple of cups of coffee a month. And we're literally building things that right now are not possible, but we know in 6 months there will be. And it's just because AI is getting cheaper because the chips are getting better. So there's real use case coming out of this. But the question for you becomes, are you positioning your portfolio for the short-term headwinds or the longer-term technological tailwinds? What's your time horizon, right? Now, in my experience, the investors who thrive are those who can balance. Looking at the near-term direction, the market appears to be in this state of Powell's measured tone leaves room for optimism if upcoming economic data supports eventual easing. However, and this is important, those corporate controversies we discussed are likely to continue dampening enthusiasm. So now, I've been analyzing market patterns for well over a decade, and my mentors have done it for about 50 years. And the market's all about patterns, by the way. That's really how we make money. And to me, this says we're likely heading into a period of increased and possibly increasing volatility. What does that mean for you? Well, it means you might want to reassess your risk tolerance and perhaps diversify a little bit more aggressively than you would normally do. And then for the second half of 2025, things become rather more interesting. With projections indicating at least 2 to 3 rate cuts, we could see renewed money pouring into asset prices and therefore uplifting stocks. But do note, this optimistic scenario depends heavily on how fiscal policy, so government spending, evolves and whether these corporate government stuff that's going on out there, whether that gets handled. And have you considered how your portfolio might respond to these rate cuts, right? Would you benefit, or might you actually be positioned contrary to where the market's heading? That's important. And then when we integrate all of these micro and macro influences, so the small and the big, we get this fascinating big picture. The Fed's current stance and Besson's cautious rhetoric are certainly giving us anxiety, but, and this is crucial, the narrative is counterbalanced by these exciting tech developments. So we might see in the longer term a positive shift towards high-value tech stocks, right? And the investors who've historically outperformed in these conditions are those who maintained disciplined positions now, so maybe doing less right now, or nibbling on the right things, which in my humble opinion might be the index rather than stocks, because that's a lot more risky. But let's start our individual stock analysis here. And I want to start with AMD, which has been making some rather impressive strategic moves recently. And I've been very cautious on AMD. I've been warning since about October or November, saying, hands off this thing. This is going to go lower. The chart is saying it's going to go lower. The pattern is what it's all about. If you know what the pattern's all about, you don't buy these falling knives and you want to learn the patterns. Well, watch the masterclass, right? The link is down below, felixprehn.com/get-free. But AMD has solidified a significant partnership with Oracle. And this isn't just any ordinary collaboration. Oracle has placed an order for 30,000 of AMD's GPUs. They're called MI355X, if you care. And this partnership is part of AMD's broader strategy to expand its AI GPU business, where JP Morgan is expecting AMD to achieve over 60% growth this year. Yeah, JP Morgan, probably the most important investment bank in the world. And Well, if you ask JP Morgan, they would kill you for saying probably. No small egos there. So to put that in perspective, most tech companies will be thrilled with, say, 20% growth in any segment. What's particularly interesting is that Oracle is planning to double its data center capacity this very year, which aligns perfectly with AMD's GPU offering. So it puts AMD in a rather advantageous position to capture a larger slice of this market. Now, looking east, AMD Japan announced on March 17th that they've achieved a 45% market share in the graphics card market. And the statement from AMD said, AMD just isn't used to selling so many graphics cards, which is kind of refreshingly honest, isn't it? And it indicates they're experiencing demand that has exceeded even their own projections. So what are the strategic implications? Well, there are two. First, the Oracle partnership positions AMD firmly to benefit from this whole computing race. And second, their market expansion in Japan means that they might be able to penetrate highly competitive markets and compete somewhat with NVIDIA. Now, regarding market sentiment, the unexpected surge in graphic card sales suggests AMD might need to adjust their production strategies. So how would you approach AMD? Is now the time to be jumping in on this? Well, let me open the chart for you here in Trade Vision so you can see what's going on there. And by the way, we've also just included a professional analysis of everything that's going on with pretty much all the major stocks here. You can see that on the top right up here, as well as the key drivers like what the conference is saying, the price range, competition, market sentiment, all that kind of stuff. But I'm going to say something to you that the AMD lot isn't going to like. It's still too early. Because if you look at the chart here, and I put a couple of lines in there, like that red one there, we're still way, way, way below any kind of breakthrough. It was still a falling knife, so I still wouldn't touch the bloody thing. And if you want to learn exactly where I will be buying AMD, because I probably will be in 2025 at some point, but not right now, well, just watch the masterclass. And that way this video is 15 minutes shorter, which I think is going to be to everybody's benefit. And if you watch the masterclass already, put freedom in the comments, and then I know that you've actually seen it, which is going to be exciting. And of course, also let me know how much you got out of that. And a lot of you guys are telling me you're getting tremendous value out of that, and you're watching it 2 or 3 or 4 times, which is super, super cool, which is entirely my intention. So let's talk about software, because NVIDIA also released the Dynamo software, offered for free, mind you, which aims to accelerate AI reasoning processes. And this addition to their software ecosystem complements their hardware offerings quite nicely. And another significant announcement was their partnership with General Motors, where NVIDIA has been selected to build GM's self-driving car fleet. And this expansion into the automotive sector opens an entirely new revenue stream. In a rather bold move, Huang directly challenged Broadcom's ability to win market share in the AI chip market. He specifically questioned Broadcom's earlier statement about securing 3 potential hyperscaler clients in the custom chip market. That kind of direct challenge is pretty rare in the corporate world of Wall Street, and it shows you a lot about Huang's confidence in NVIDIA's positioning. Why did the share price dip? Well, it suggests that investors have already priced in much of NVIDIA's growth narrative, and as one analyst put it, the AI industry's long-term reliance on NVIDIA's chips is well understood, but short-term expectations remain unchanged. So given everything that has happened there on the NVIDIA front, how might you trade it? Well, let me pull the stock chart up for you in Trade Vision. And I encourage you to get yourself a free trial so you've got some really, really decent data there. And what do you see? Well, we've got a support line in here, and you can toggle those on and off. Those aren't like random lines that we draw in the sand. They actually tell you where the hedge funds have to buy NVIDIA. So at like $110, the guys have to buy. That's your support. And if we get to 130, they have to sell. So that's going to be a little bit of a lid on the party. But what I'm a little worried about here, teeny tiny bit worried about here, is you see that yellow line there that I'm pointing at? That is the 50-day moving average line. And can you see the slope? It's sloping down. Right? We don't love that. Also, the last candle here that I've got was a red candle, right? We dropped, and volume actually picked up. So we're not in a positive momentum sentiment kind of a thing. And in fact, if you look at the entire bounce from the market lows, we have this little bounce here, right? Look at volume. Volume is actually declining. So what is that saying to you? There are more people excited about selling NVIDIA than they are buying NVIDIA, because the higher we go, the less people are buying. That's really, really important to understand. So in my opinion, it's a little too early to nibble on these stocks. I think they might go a little bit lower. But let's continue our analysis here with another market mover. Moving on to Tesla, which has been experiencing quite a tumultuous period lately. Elon Musk's increasing political involvement, particularly his leadership of Doge, has had rather profound impacts on Tesla's market performance. Most recently, Musk's earlier retweet about accusations against billionaire Carlos Slim reportedly led to a staggering $7 billion loss in a Starlink contract. And that's the sort of financial impact that would make even, well, Winston hide under the sofa, under the desk in this case. And then there is the Doge Quest doxing incident, where Tesla owners' personal data was exposed, apparently in retaliation for Musk's political actions. Musk's response was, well, characteristically unfiltered. He claimed there is hatred and violence from the left and mentioned burning down cars, firebombing dealerships, firing bullets into dealerships, and smashing up Teslas. Now, regardless of one's political leanings, this sort of rhetoric doesn't exactly help calm the waters, but I can also see why it's just entirely freaking unacceptable to use violence to make a point. Actually, what is the point? If people have a point, they explain it. If people don't have a point, they firebomb you. That's kind of, I think, how that conversation is summed up. It's just people, in my humble opinion, who are pissed off about losing their, handout money. There is a British politician, Rory something or other, who complained on a podcast a couple of weeks back that his wife's charity lost $1 million from US aid, which was contractually promised. And you know what that charity does? That charity shows modern, abstract, weird, distorted art to Afghan women. Is that their number one concern in Afghanistan? To see really, really weird art. That's kind of crap that got funded, and he's pissed off about it because undoubtedly his wife got a very nice salary from that charity, right? It's just corruption. That's really all it is. I'm not saying everything they're cutting should be cut, but what I'm saying is that there's a lot of stuff out there that is just utterly wasteful. And now some people are going to go off in the comments, but that's okay. If you want to go off in the comments and criticize what Doge is doing, please explain why. Don't just use expletives. Explain why. And that way we can actually learn from each other and have a better conversation and come to a conclusion here. But the numbers are also sobering on Tesla. Tesla's vehicle sales have plummeted. A German publication published a survey that said 94% wouldn't consider purchasing a Tesla, although I've seen a different survey which said exactly the opposite. And surveys, well, you can make people say whatever you want if you run a survey. But these statistics, they keep people up at night and it gets people exciting. And there is, however, a glimmer of hope among all these challenges. On March 18th, Tesla received a crucial regulatory approval from California's Public Utilities Commission, marking a significant step towards launching its robotaxi service. The CPUC, in short, granted Tesla a transportation charter party carrier permit, allowing the company to operate a fleet for prearranged employee transport initially. Now, while this permit does have limitations, it provides Tesla with an opportunity to test and refine its autonomous driving technology. And the company's next step in applying for additional permits will, of course, be critical in determining the timeline for that full robotaxi service launch. Now, given all these mixed signals, political controversies, sales declines, and regulatory progress on the other, how might one approach trading Tesla in this environment? Well, let me open up the Tesla stock chart for you here inside TradeVision, and it is a sorry state of affairs, isn't it? We just added a little measuring tool here so you can see the full misery. We're down about 53% or so as I'm recording this, right? Which is not exactly glorious. We've also put all the key information in here, everything that's going on out there, from insider sales to self-driving and protests and all that kind of stuff. It's all in there, so you can really see what's going on here. So we are hovering about $30 above the support line, which is good, but we have an indicator that literally nobody has out there. And we can see how Wall Street has changed its positions And you can see the hedge funds used to be up here. And then they moved down here, and then they moved down here, and then they moved to here, and now they moved to here. So they keep shifting their expectations lower, and that isn't really a good thing, because that's a big, big, big shift. So we're now at the same lows that we experienced, well, before we started collecting this data, because nobody else has it. And it's telling you a very, 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 very bearish scenario. Now, something to bear in mind is that markets always overreact. And if you do believe that they are going to solve robo-taxis and robots perhaps later in the year or next year, then this could be, of course, be a glorious opportunity. But be wary that this is likely to go lower. As we go down, the volume of sales has gone higher. As we consolidated here the last few days, volume has declined again, so there are less people excited about that. And that just says to you, warning, warning, warning. And sell up here, where to that blue line, or maybe there, or certainly here. And again, if you want to learn those very rules, because they really are rules-based, then I'll teach it to you. And then next time a crash happens on one of your favorite stocks, you will be like, okay, I know what to do here. I'm not going to be in a 50% drawdown, and I'm going to have to wait till whenever that recovers. Personally, I'm a long-term Tesla bull, but that doesn't mean it's going to recover next week or next month. I think this is going to be one that's going to take a while, and a lot of people got burned from it. The real question is, of course, now, are we going to go below the sort of consolidation period where we're back, right? We're basically back in that zone here where we were, and really the question is, are these guys going to sell, right? Are they going to sell at zero, which is a temptation for people, in which case we would go back to the next lower level, which would be at like 170. Not saying that's going to happen, but it is a significant risk. The more we drop, the more people are going to sell. It's a self-fulfilling prophecy. Now, let's examine another tech giant here, which is also making significant moves. On March 18th, Google announced a substantial acquisition. They're purchasing Wiz, W-I-Z, a leading cloud security platform, for a whopping $32 billion in cash. They just had that in the top drawer. And this is Google's largest acquisition in its 26-year history, dwarfing the previous record of $12.5 billion for Motorola in 2012, which I think was all about patents. It wasn't really about the business. Now, the market wasn't impressed by it, but the acquisition aligns with several key strategic objectives for Google. First, significantly boost their cloud security capabilities. With the increasing adoption of cloud services and the rise of AI agents, cybersecurity is just paramount, right? And Wiz's platform is basically designed to connect all major clouds and code environments and help prevent cybersecurity incidents. And it'll enable Google Cloud to offer a end-to-end security platform, basically, improve how they operate right now. Now, what's particularly interesting is Google's emphasis on maintaining Wiz's multi-cloud capabilities. So they've stated that Wiz will continue to support all major cloud platforms, including Amazon Web Services, Microsoft Azure, and Oracle's cloud. And that's crucial because many organizations use hybrid cloud systems. They don't want to rely on just one company, so they use multiple, especially if you have a critical business like banking or utilities or something where, an outage was not something you can afford. You're going to have your data in several systems. Now, in terms of competitive positioning, Google Cloud currently trails behind Amazon and Azure in market share. By acquiring Wiz, they aim to gain a competitive edge by offering a better security solution. Maybe that'll give them a little bit more edge over customers. So how do you approach Google in an environment like this? Is it still the cheapest? I think it might still be the cheapest Mag 7 stock out there, is it? I think it might be. And what have we got here? Well. We caught a nice breakout up here. We zigzagged, right? And if you watched my masterclass, you recognize that zigzag. We had a breakout and then we had a collapse on earnings. And earnings are always high-risk events. So what did you want to do? Well, you want to set a stop loss so that at least you get out of this when you cross here below that 50-day moving average line, which is the yellow line there, in which case you would have gotten out, all right, which is always what the point is. Like, not every breakout is going to make you rich. If you want to win every trade, well, don't trade, don't invest. It's not going to happen. Trade outs, say we had a breakout here, for example, And then we actually went up very nicely. So if you had good risk management, you would have gotten out here or there, in which case you would have made money, both directions. And that's really what it's all about. Risk management is 9/10 of profits. And the other thing is just selecting good trades, selecting good investments, not just being an active person. And that's one of some of the hardest things to do. Now, yesterday we dropped really, really low here to below the $160 mark, below that support. And then the hedge funds basically helped us recover by holding up that support line. And that's quite positive in a sense, because we get this sort of hammer candle where you have a candle like this with a very long tail, which means we dropped all the way down, and then the market bought us all the way back up, which means that at least there is a line of defense. But of course, the actual chart itself isn't pretty, and the sell-off is significant. So am I buying Google here? No. If you want to find out exactly where I'm going to buy Google again, which I undoubtedly will at some point this year, watch the masterclass down below. I'll give you the rules. I'll tell you exactly how to apply the rules to all stocks, not just Google, and that way you learn the rules rather than getting one little tip. Tips are useless. So what have we learned today? Well, the market is clearly in a very, very complex, very volatile environment. We've got monetary policy cautions, we've got recession warnings, we've got corporate controversies, we've got all that stuff. And yes, we've got tech innovation, particularly in AI and self-driving, and all these amazing things are going to happen and are going to create a lot of value. So the question isn't really whether to participate, but rather how do we position ourselves? When do we position ourselves? And a lot of people freeze in times of uncertainty. So they miss out on hugely rewarding setups, because when this recovers, there will be hugely rewarding setups. And they also don't know how to implement risk management. And that's really the number one thing I want to get across to you here today is learn from this dip. Make this the last dip where you are caught with your trousers down, because that's what most people are right now. And it means you can't take advantage of the dip because you haven't got enough cash, right? And that is why risk management is so very important. So take a moment, reassess what you've been doing. You can import your entire portfolio or your trades into Trade Vision. We have a trade tracker. You can also use it for your investments, and it'll show you exactly what's actually going on with your portfolio, and it'll allow you to come to conclusions that you haven't come to yet. And in the future, then be able to position yourselves to benefit from the amazing stuff that's going to go on there. I believe we're going to have a good end to the year, but I also think the next couple of weeks and months are probably going to be tumultuous, because we are seeing more change than we've seen in many years. And that causes uncertainty. And as I said at the beginning, the market hates nothing but uncertainty. If you got some value out of this video, write value in the chat down below. But most importantly, get some value for yourself by actually learning the rules, learning the systems, understanding the patterns. They are so obvious once you understand how they work. Don't be put off by all the stuff that you've been fed by the financial industry, which basically tries to scare you into touching your investments. You are smart. You earn the money. You are capable to manage the money, but you do need some guidance. You do need some education. And my intention here is to offer you and give you exactly that. So head over to felixprehn.org/getfree, and I wish you a beautiful day. Felix and Winston here, and if you're worried about what's happening to your favorite tech stocks, this video is for you. Fed decisions, Tesla's shocking 50% crash, and Apple teetering on the edge of critical support. The next days could reshape your entire portfolio.